Hello, everyone, and welcome to the Microstructure Exchange. Today, we're very happy to have Amit Goyal here to talk about the drivers of corporate bond lending. Before I give the screen to Amit, I want to announce our call for papers for the next semester. You can find the submission link on our website, and the deadline is on December 15th. And so we look forward to see your papers for the next semester. Amit has said that it is fine to ask questions throughout the talk. So please go ahead and do that. If you can't ask in voice, you can type your question in the chat, and I will relay the question to Amit. So I think that is all. Amit, the screen is yours.
Thank you very much, Bjorn, for having us, giving us an opportunity to present this paper. It's new work. We have not submitted it anywhere. We are still collecting feedback. So I am very happy, very grateful for this opportunity, and looking forward to any and all the questions that you will have for us. As Bjorn said, please ask me questions as and when they appear to you. There's no reason to wait for a pause or something. And also, if you have any questions, please just unmute yourself. If you can, just unmute yourself and ask me. Or like Bjorn said, you can type the questions in the chat window, and then I'll try to read it, or Bjorn can help me if I miss.
Yeah, I will monitor the chat, Amit.
Good.
So you
Thank
don't
you.
need to have that distraction.
Good. Thank you. Bjorn. All right. Okay, so the title of the paper that I'm going to present today is on the drivers of corporate bond lending. This is joint work with Yosh, who is at Toronto, and Yancheng at Sydney. And I see in the participant list that both Yosh and Yancheng are here. So thank you, especially to Yancheng. I don't know what time it is for Yancheng, like 3 a.m. or 4 a.m. So thank you, Yancheng, for being here. All right. Okay. So now, what is it that I want to present? What is it that we are trying to do? We are going to study the market for borrowing and lending corporate bonds. Okay. Now, obviously, there's a huge literature on borrowing and lending in the equity market. Many people here in the audience have contributed to that. They've worked on that. It may come as a surprise to some people. I don't know, depends on your reading of the literature, that actually, if you look in the corporate bond market, the corporate bond lending market is almost as active as that of the equity market. So here I have a graph which shows the loan quantity on bond versus stock, and I'm not even going to look at which line is which, because I mean the legend is here, you can see it. But the line kind of shows that the bond lending, the amount of lent in both the stocks and in both stocks and bonds is similar. I don't have a figure here, it's in the paper, but in which we also show that if you look at the borrowing fees, both in the stock and the bond market, they're also comparable. So despite the fact that bonds are typically thought of, and they're true, is they're more expensive to trade, in terms of bond lending, that seems similar to that in the stock market. So what is it that we want to do? Despite that fact, there are very few papers which study corporate bond lending. Okay, so what we want to do is we want to understand in the corporate bond market, who are the people who are selling, short selling these corporate bonds. Broadly speaking, I'll get to the details in just a few minutes. You can think of like there's two people who can be selling, who can be borrowing the bonds. Either you can be an investor, an informed investor who's borrowing the bond because you have some information and you want to trade on that. So that's why you're borrowing and shorting. Or it could be the dealers who are the liquidity providers, right? So they have some need for bonds because of their liquidity inventory purposes, and they are the ones who are borrowing these bonds. So both of these kinds of participants, dealers and customers, exist both in the equity and the bond market. And I'll show you that I'll make a distinction between what is typically happening in the equity market, as shown by many papers, and what happens in the bond market, which is the focus of going to be the paper focus of our paper. To give you like a simple punchline, right? This is the paper, right? If after that you don't want to listen to anything, that's fine. I'm just going to give you the punchline just right now. In the corporate bond market, we are going to establish that the short sellers are predominantly dealers. Okay, these are the dealers who are the liquidity providers. They are going to be borrowing bonds in order to fulfill the customer end demand. This is different from equities, where predominantly the people who are borrowing the people who are borrowing the bonds are typically the informed investors. So the speculation is, so bottom line, the speculation is the primary motive to borrow stocks. But in bonds, the primary motive to borrow bonds is for intermediation purposes. That's going to be the punchline of our paper, and I'll tell you lots of things how we get to that. In fact, you will see I will have lots of pictures for you. I do have 3 4 tables with like big regressions and so on, but hopefully I will be able to convey the message that we have with just a picture. So that's going to be the first part of the paper, the main part of the paper, the main thing that I want to show you today: who are the short sellers in the corporate bond market. If time permits, I will get to the second part of the paper, in which we will look at, okay, well, if what we said is correct, that dealers are the primary people who are selling, who are borrowing the bonds, what does it mean? And there I will show you what are the implications for the passive ownership. Passive ownership in the bonds has also increased. As passive ownership has increased, what does that mean for borrowing the corporate bonds and so on, or the bond lending, etc. Again, I will make a contrast when I get to the second part, to the results and the literature on the equity market, right? So that's going to be the bottom line. That's going to be my roadmap for today. All right. In terms of yes, there is a question.
Yeah, so you did not include the motives. There's a big repurchase market, right? Which
Yeah,
may be more active for the bonds, especially because they're
yeah,
good collaterals.
yeah.
So how do
So
you?
correct. So there's actually, you're right. Actually, there's 3 motives could be, and I will get to that in one more slide. Okay. I mean, the short answer to your question is going to be that that's not important. At least in the data sample period that we are looking at, that's not the important motive in the corporate bond market that we are looking at. But let me get to that in just 30 seconds. Let me just talk about the data sources, and let me get to that. So data sources. One of the things which I mean, we spent a lot of time collecting different data. I say we is really hats off to Yancheng, who's done lots of this work. We have collected data from variety of sources. Bond lending data comes from market, characteristics from merchant, transaction volume and direction from trace, bond returns, etc., etc., etc. There's lots of details behind that, matching all those data. It's matching all those different databases, etc. I have no time to talk about all of that, but obviously I'm happy to converse with you later for any details. At the end, in most of the results that I will show you, we will have about 10 million bond day observations. I'm going to conduct most of my tests at daily frequency. So it's going to be 10 million observations for about 11,000 bonds issued by about 1,200 different firms. The sample period is going to be from 2006 to 2022. All right. Okay. All right. Now let's get to what are the main motives for borrowing bonds. So I talked about two or three. One, I talked about the number one, right? So the first thing that most of the people think about, why do investors borrow bond? That would be for speculation purposes. Speculation that these are informed investors. They have some information, negative information about the bonds. That's why they borrow and short. That's the first thing which comes to people's minds. But then second, which is going to be the focus of our paper, is market making by dealers to fulfill client buy orders. I am the dealer. Josh is the customer who wants to buy, okay, for whichever reason he wants to buy. I am the dealer to fulfill Josh's demand for buying. If I don't have these bonds in my inventory, the dealer, am going to borrow, give it to Josh. That makes me as the person who's borrowing and shorting the bonds, but it's not for speculation purposes, is for market intermediation. So that's going to be our focus, the second bullet point. And then the third one is collateral for financing trades, right? So this is going to be like a supply side factor, etc. In our sample, right, there's this third motive might have been important in the early part of this century, but it's really not the main driver at all after 2008. So we don't talk much about it in the paper. But Pankaj, if you had a...
Yeah, oh, okay. Why is it not? I think it's still very active, the repo market, right?
In the corporate bond market?
Yeah, I mean, I don't know why you thought it's not important after 2008.
So I will have to, there are some, I'll have to defer that. There is some numbers we had in terms of, Pankaj, let me defer
Oh,
that question.
yeah.
But the short answer is there are some fees that we looked at which made us suspect it's not right. But I'm blabbering right now because I don't remember right now. I will look into it and I'll get back to you. But for
Sure.
us, it's suggested that that's not the main thing which is happening in the corporate bond market. But now, if you're saying that this is still, the repo market is still very important in the corporate bonds, maybe we can look at it again, and we will look at it.
One more quick question I'll
Yes,
ask. So
yes.
this market making, this is still informed. If the dealer is willing to short, they are still shorting, they are still informed. I don't know why you say it's
When you say
market
they're
making.
informed, I mean they're fulfilling their market making whatever, they're doing market making, right? So when I think of informed, I think of you as informed. You are informed, you have some negative information about the bond, you're going to short it. And
No,
when
they
I...
will not sell, right? If if they have to borrow, they will not do it if they don't think that the bond is overvalued.
So correct, right? So it could be, but if I'm just a dealer, I'm just doing market making, I don't have any information, I might adjust the spreads, but I will adjust the spreads. That's my dealer market making.
Yeah, that is market making. But borrowing and taking your own proprietary position is still informed trading.
That's correct. If
So
my
dealer
own
is informed, right?
proprietary position could be still informed trading. That's correct,
Mhm.
right? So somehow we will have to disentangle that. I will have to
Right.
show you some results why that would not be completely, that's not what's going on in the data that we have.
So,
You're right,
thank
right? Obviously, you're absolutely right. My own proprietary position would still be informed, and I'm going to show you that that's not what really is happening in the data. Beyond, I think there are some couple of questions in the chat. I don't know if I need to answer them or not right now. But I'll continue.
No, that was mostly
Okay.
me telling people how to ask questions.
Okay. All right. Okay. Thank you. Okay. All right. So now I'm going to show you a picture actually, but before I show you the picture, let me explain to you what I'm doing. So now what I'm going to do is I have short volume from market, and I have the volume, the buy volume and the sell volume, which comes from the enhanced trace, because I don't need to do any Lee ready. Enhanced trace tells me the direction of the trade and so on. So this is what I'm going to do. I'm going to relate the buy volume to the amount which is shorted, and the sell volume to the amount which is shorted. In doing that, one thing I'm going to be very careful about is the settlement. The settlement used to be T plus 3 before 2017. It has become T plus 2 after 2017, and my understanding is it's now T plus 1 after 2023 or something, which is not in our sample, but the settlement period has changed. Now, this is what I want to do. Actually, the regression here, it kind of seems weird. I'm going to show you the picture already. So what I'm going to study is, so imagine that the trade happens on Monday. Okay, whatever the trade is between the dealer and the customer, which happens on Monday. So in my example before that I took, Josh is the person who's trying to buy something on Monday. I'm the dealer. In my story, I, as the dealer, I don't have the bonds, enough bonds, so I'm going to borrow and fulfill Josh's demand on Monday. Trace will record this as a buy volume for Josh on Monday, but the market data will record the amount sold on the settlement date, which is going to be T plus 3 Thursday. So what I'm going to relate is what is happening to the amount, the short quantity on Thursday to what the buy and the sell volume was on Monday, 3 days before. Why 3 days? Because the settlement is T plus 3 days. Now, this is the, let's say the relation, I mean, the regression is written here, but this is the relation between the amount which is being shorted and the buy and the sell volume on Monday. Now, two possibilities, right? So the first possibility is that actually the shorting is happening due to Josh's informed activity. Or let me take somebody else. Let's say Bjorn is the informed investor. He is the informed investor who wants to short. Then on trace, it will be recorded that Bjorn is selling. That will be recorded as a sale volume. I will record, market will record this as amount additionally sold. So what I expect to see is that the sale volume, the red column here, is positively related to the amount quantity on loan. On the other hand, if market making activity is the one which is going on, Josh is actually buying. For which reason, I don't know yet, but Josh is actually buying. I, as the dealer, am fulfilling his demand by borrowing. Then you would expect to see Josh's borrowing positively correlated with the amount on say, the quantity on loan. Right? So the prediction is a positive relation between the blue and whatever I have the quantity or loan if market making is the dominant thing, and a positive relation between the red, which is beyond sales, and the quantity or loan if the informed trading is the primary activity which is happening due to short sell. As you can see in the data, what we find is there's a much stronger relationship with Josh's buying on the market, on the amount and quantity on loan than what it is from Bjorn. Okay. In fact, the relation between the selling and the quantity alone is negative, which is opposite of what you would expect from which is opposite of what you would expect from speculative short selling. So this picture, in fact, to me, I mean, I really like this picture. This picture to me kind of gives the punchline of the paper that most of the shorting activity is related to customer buying. Sorry, I went too fast, then to customer selling. This is happening before 2017. After 2017, like I said, the trade happens on T plus 2. So what we are going to do is we are going to just run the same regression and just again look at the days and so on. And you can see the picture looks almost the same, except everything is shifted to date T minus 2, which is what you would expect based on the trading T plus 2, T plus 3, etc. So this picture tells to us that dealer market making dominates. Now, this is a little bit reduced form analysis in the sense that I'm telling you the dealer market making dominates, but dominates, how much does it dominate? That's not yet established. So is dealer market making 50% of the activity, 70% of the activity, 90% of the activity? That's not evident from this picture, that I will get to this kind of a variance decomposition. But to me, this picture, as they say, you know, the cliched saying, a picture speaks 1,000 words. This picture tells to me that it's the dealer market making, which is more important than the informed thing. Now, this is the main thing. Obviously, we want some corroborating evidence for why, if this is happening, something else should be happening, etc. So we look at a few things. Let me skip this. Let me get to this first thing, right? So Pankaj as well. Okay. So now my story is Josh wants to buy on Monday. I'm going to sell it to him the dealer, I'm going to sell it to him on Monday. But since there is extra buying pressure on Monday, as the dealer, I'm going to do something. What am I going to do? The usual things. As if there's a buying pressure, I'm going to increase the half spreads for the buy trades. If my story is correct, again, you would expect to see that the abnormal half spreads on day T minus 3 for the buy trades. Buy for me is always going to be in the blue, are going to be higher, and the abnormal half spreads for the sell trades are going to be lower in response to this market making activity that I'm doing. So this evidence again is consistent with my story. On the other hand, the fact, when I say this evidence, I really mean, I'm not even showing you the magnitude of these coefficients. I'm just trying to show you that the positive and the negative part, right? And obviously you can see from the standard error bars that they are significant. But the fact that this is positive on the buys and the fact that this is negative on the sells for the abnormal half spreads again is consistent with the story that I'm selling, and is inconsistent with the story which would be that it's beyond short selling, informed short selling, which is related to the quantity on loan on Thursday. Same thing on day T minus 3. As before, if I skip one day and I get to sorry, if I look at the second period after September 5th 2017, picture looks the same, except the action obviously happens on day T minus 2 instead of day T minus 3. All right, so that's first piece of corroborating evidence. Second piece of corroborating evidence, maybe even more important. Once again, I know I'm saying the same thing again and again, but to me that's the important thing. In my story, the action is happening because Josh is initiating a buy trade to which the dealer is responding, right? If that were the case, now I don't know why Josh is interested in buying, but again, one hypothesis would be Josh is interested in buying because he has positive information, because he's buying. If that were the case, then you would expect to see that the short selling is related to positive returns, because short selling is a market making activity in response to buying by the investors. Once again, I want to again contrast with the informed trading. The informed trading hypothesis would be that shorting is happening due to beyond, who's an informed investor who has negative information about the bond. If that were the case, you would expect that the shorting activity is related to future negative returns. What we find is, again, this is day T minus 3, T minus 2, and I'll have a regression, by the way, for that later. I'll show you. But you can see here that the returns are positively related to the amount on sales. This really is actually quite striking compared to what you see typically in the stock literature, where shorting is associated with negative returns. And at least in this picture, and I'll try to be even more careful later, but this, at least this picture says shorting activity in bonds is actually related to positive future returns, which to me again is a strike against the informed trader hypothesis, but is consistent with the dealer market making hypothesis. Okay, same now. So this is again, I'll show you the same thing. This is something is happening on day T minus 3, by the way. Something happens on day T minus 2, right? The information that Josh had because of buying, it may not be only on Monday, it could be happening on Tuesday, Wednesday, and so on. So we will look at like future 3-5 day returns in the regressions that I will have. And obviously the action shifts by one day after 5th of September 2017, again in response to the trade cycle, etc. Now, let me show you one last thing maybe, and then I'll pause for like maybe 30 seconds. Everything that I've shown you so far is for bonds, right? I can obviously show you similar thing for the stock also. I can run similar kinds of regressions, etc. for stocks also. And for stocks, this is the interesting thing, that when I do this for the stocks, this is what the interesting thing I want to show you. This red thing, which is the customer sales. So now we are talking about the stocks. In stocks, the typical story is that it's the informed investors who are shorting because they have private information. That's what they want to take advantage of. In that story, there should be a positive relation between customer sales and quantity on loan, which is indeed what we find for the stock market. So our methodology kind of uncovers what's happening in the stock market. Everything that has been shown for the stock market, obviously we are not debating any of that. Our methodology uncovers the same thing. What we are saying is that in, again, the bond market, most of the activity. I should not keep saying most of the activity because I haven't shown you what most is. I'm getting there, but it does suggest that the borrowing, the bond borrowing, the shorting is being done by dealers in response to customer buying. Let me stop here for like 30 seconds and see if there are questions. There was something in the chat, maybe Bjorn, or no?
There was a short question in the chat, but your co-author has responded to that.
Okay, all right, thank you.
I have another question for you.
Yeah.
So the dealer here is facing the cost of borrowing the bonds, and then on top of that, you showed there is price impact moving against
Yes,
the dealer.
yes, this
So
one, correct.
can
Yes.
you talk about the economic magnitudes here? Is the spread wide enough to cover both of those costs?
I think this I don't have the top of my head. So your question, if I understand correctly, is since the prices are moving against the dealer, is the spreads being charged by the dealer enough to cover this? I
Both the
don't.
price impact and the cost of the borrowing the bond.
Yeah, I don't have those on the top of my head. But we will. I don't have the top of my head.
Sure,
So
sure.
something we need to look at. Something we should
Fine.
look at.
A
Pankaj,
quick follow-up on Bjorn's question. So it seems like you're saying in the equity markets, some third-party short sellers are more informed, but in the bond market, the dealers could be the more informed parties, right?
I mean, again, sorry to keep. I don't want to say informed. They're just doing deal. They're just doing market making.
But they can select, right? It's not like an equity market, they're always in the buy and sell side. These dealer markets are much different. They can decide, yeah, I want to sell if you're buying. It's more matchmaking, right? So you can match the trades where you feel more informed and not match where you don't feel you're more informed. Unless there is a requirement to post both sides.
Okay. I mean, the way I was thinking was Josh wants to buy a bond. I don't question why Josh wants to buy a bond. And you're saying if Josh wants to buy a bond, I can just not provide that bond to him.
Right. Yeah. If you feel like he is informed, you don't provide. If you feel the dealer feels I am more informed than the buyer whom we
Correct.
just treat for liquidity reasons, then let's sell it to him and we'll borrow it and take the chance, right?
And this will not be this kind of a story is not there in the equity market, because in the equity market also one could say the same thing.
No, but equity is much more competitive liquidity supply, right? So compared to the bonds.
I see. Okay.
So now we have a couple of comments. Sorry.
Yes.
Um,
I'll have to think, Pankaj. I'm not sure that I have a good question, but I have a good response. It's a good question. I have to think about the flexibility that dealer has in doing the
Right.
market making for the specific bond needed by Josh. That's the question you're asking.
Yeah.
And we are assuming that the dealer does not have that flexibility, and you're saying the dealer actually does. Okay, I understand. I understand the spirit of the question. I don't have an answer. Need to think about it. Beyond. So somebody asked, can you help me,
yeah,
please?
so Dmitry Muraviev is
Dimitri.
writing a comment.
Dimitri, please ask me. You just can unmute and let me, Dimitri.
I mean, sorry, it's noisy here, but basically in the stock market, half of the short volume is just citadel, right, for market makers, right? So in that sense, like most of short volume is intermediation, similar to what you find in the bond market. So in that sense, your results are not too inconsistent with the stock evidence. It's just that citadel doesn't carry their short positions in the stock market overnight.
So in the stock market, the results are in. So if I just look at the slide which I'm on, in the stock market, the result is short activity is associated with negative returns, right? There's huge literature on that. And I'm actually, let me get to that. Let me show you, for example, I'm going to run a regression of returns on lots of things. And it's a big regression, like there's lots of stuff going on. But let me just focus on the first number. I'm looking at the cumulative returns over the next 5 days in response to shorting. and you see the coefficient is positive. We have done it also for portfolio sorts. I don't have the table either in the paper or with me here. But the result is that this shorting activity is associated with positive returns in the future. So in that sense, it's inconsistent with the equities. Right? I don't know if that answers Dimitri's question. Was there anything else beyond about?
No, we can move on.
Okay, all right. Let me see. Oops, I have only 15 minutes. Sorry, I need to speed up. Sorry. Okay, all right. Okay, let me speed up then. All right. So
yeah,
now
it's no problem if you go over 5 minutes or so.
no, it's okay. No, but I don't want to. The time which is scheduled is the time which is scheduled. Let me quickly do two things. Okay. Previously, now I've shown you, or I have tried to convince you that most of the shorting is being done by dealers. Now, I want to quantify what does this most mean? How much is most? That's what I want to do. In order to do that, I'm going to do a very simple, it's not even a model. I'm just going to do some algebra in which I'm going to write down that, hey, the shorting, the loan quantity, the shorting can change either because of new short positions or covering of previous short positions. This can be done either by the dealer or by a customer. Okay, I'm just going to write down simple algebra. This is not very complicated, very simple algebra, which is saying that the shorting quantity on day D is either new short positions or short covering, and that's happening either because of a sale or because of a buy by a dealer or by a customer. Okay, now I know I'm going really kind of fast in this, but and I'm happy to talk later, but let me just write it down like this. Now, I do not observe as an econometrician who is the dealer, who is the customer, what is the sale, and what is the buy. All I observe in the trace data is the buy volume and the sell volume from the customer point of view, right? Which in my setting is a combination. For example, the buy volume is a combination of either the buying done by the customer or the selling done by the dealer. Again, in my example, Josh was the one who was buying, I was the one who was the dealer who was selling. So that's going to be the buy volume. Similarly, I can write down the sell volume. So all I observe in the data is the short amount, the DQ, and the buy volume and the sell volume. And what I want to infer from these three things that I know is how much of that is coming from the dealer, how much of that is coming from the customer. So all I'm going to do is run a simple OLS regression of the buy volume on the DQ, the same way that I ran, the same way that I showed you the charts. I will run a regression of the sell volume on the change in the quantity the same way I showed you the charts. Do some algebra. This beta coefficient is going to be related to some variances, the beta on the buy, beta on the sale. I take a difference between them. And when I take a difference between them, this is kind of I hate to use this word, but magic which happens, or simplification, let's say, which happens from the algebra. The difference in these two slope coefficients allows me to figure out the variance share of the customer trades and the variance share of the dealer trades. So each of the beta coefficients does not tell me how much is customer, how much is so in fact, right? So let me just quickly go back for a second. I kind of lied a little bit, fudged a little bit. Okay. In the very beginning, I was telling you, look, this coefficient, the buy thing is telling me that dealer market making dominates. This is positive. This is negative. That's telling me. Actually, the coefficients themselves, whatever this number is, 0.25 here, minus 0.15 here, does not tell me much. But the difference between them, based on now the algebra that I have done, the difference between them is very informative, allows me to infer how much is coming from customer trades and dealer trades. So I'm going to do this decomposition. I'm going to do this and tell you, for example, now let's look at just the first row in which I have the slope coefficient, right? So this is what I had for the sales, for the entire sample. The sale was negative, the buy was positive. I showed you before. Now I put these in my algebra, and that algebra then tells me that if I were to decompose this shorting activity between that's coming from customer and the dealer for the overall sample across all bonds, across all days, etc., the dealer market making accounts for about 2/3, 66%, and the customer accounts for about 33%. So it's not, I am not claiming, if I said that, I apologize. I did not mean to say that. If I said that the shorting is happening only because of dealers, that's not the case. But 66% of the shorting in the corporate bond market is because of dealer market making, and only 33, one third of that is due to customer market making. This is for the entire sample. I divide it up between investment grade, high yield bonds. It does not change much. I divide it up by landing fees. It does change, but let me show you a couple of interesting things maybe. When I look at differences between public and private firms, we find that the dealer market making is a little less important in private firms. It's more important in public firms, or said differently, beyond as a speculative investor is more important, is his speculative activity is more important in in bonds issued by private firms than in bonds issued by public firms. And one reason for that, at least that's the way we rationalize it, is if Bjorn has some negative information, he can capitalize on this negative information by trading the equity of that stock. He does not necessarily need to trade the bond. So therefore, it's less important in public firms, whereas in private firms, it's a little more important. Interestingly, CDS, one could say, hey, CDS is another instrument where if Bjorn really has negative information, he can capitalize on that by trading CDSs. So you might think that the availability of CDS might impact this activity. In our sample, it does not. We look at customer and dealer shares before like important events like credit downgrades, etc. Before credit downgrades, you would expect, for example, Beyond to have more information, and you do see that that number, which 33% that I showed to you, Beyond important 33%, is more important, is 40%, and obviously for upgrades is less important. In terms of earnings news, also Beyond's activities are more important before bad news, less important for good news. So it kind of goes in the direction that we are saying. Last thing on this, and then I will move on to the last part of the paper. What about the stock market? The same thing that I did, I can do also for the stock market. Figure out how much in the stock market is dealer, how much is customer. If I apply exactly the same machinery that I have, there I find that dealer and customers are roughly about the same. Okay, but one has to be a little bit careful again in thinking about in the stock market. Even though dealers here are about 50%, I mean, in stocks, I would rather call a dealer as a liquidity provider, customer as a liquidity taker. So even the dealer in the stock market could be informed. This is what Pankaj has been saying. So, but anyway, the point, this is another number that I want you to remember. The number that I want you to remember is that in the corporate bond market, 2/3 of the shorting activity is being done by dealers, 1/3 is being done by customers. That concludes my first part of the paper. I have 7 minutes in which let me talk about the second part of the paper. All right, so imagine that this is what we have done. And what does it mean? Does it have any implications for beyond just the borrowing and the lending in the corporate bond markets? To do that, what we study is like a case study. You can think of this as a case study. How does passive ownership affect bond lending? So here we are motivated by some very new papers in the equity literature. I have listed 4 of them. All of them, what they find is as passive ownership increases for stocks, supply obviously increases, right? Passive ownership, then the supply of quantity on loan obviously increases. That's not a surprise. But the demand for shorting also increases in the stocks. There are more people who are willing to short the stock as passive ownership increases. And because of that, the borrowing fees typically increases in the stocks. What I have told you is that in the bond market, shorting is mostly a dealer market making activity. So question that we asked is, whatever people have shown for the stock, does it apply for the bonds? And my answer that I will show you in the 5 minutes that I have is no. Actually, in the bonds, as passive ownership increases, borrowing demand decreases. Since the borrowing demand decreases, actually the borrowing fees also goes down. So let me walk you through 2 or 3 steps of this logic, and then I will conclude. So first thing to establish is, well, as passive ownership increases, what happens to borrowing demand? Okay, so for that, we are going to run a simple panel regression. We have lots of fixed effects, firm, quarter, and bond. So we get identification. It's not a perfect natural experiment, but we get identification, imagining that we have different bonds of the same firm which vary in their passive ownership. And we are going to look at outcome variables like lending activities, like loan quantities, etc. So that's the regression we are going to run. Let me show you the results. Okay, so this is a panel regression in which the independent variable is the passive ownership, and the dependent variables are a variety of them. So what are the independent variables? Let's start with column 2 actually. As passive ownership increases, lendable supply increases. Duh, obviously, right? There's nothing in column 2 except just to corroborate that what we are doing is right. Now, loan quantity decreases. Okay, this is an equilibrium loan quantity. This decreases, but the effect is not very significant. I'll have a graph to show you why we still think it's an important thing. But importantly, the borrowing fees decreases. This result in column 3, for example, is completely opposite of what people have shown for the stock market. So what is happening? Let's just draw a simple supply and demand curves. Okay, as passive ownership increases, obviously the supply curve shifts out. Okay, now we don't obviously observe the demand curve, we only observe the equilibrium quantities. That's the regression that I showed to you. But if you think the picture that we have is the demand, so for 30 seconds, just stay with me and just give me the benefit of doubt that the demand actually shifts down, that the demand for shorting goes down as passive ownership goes up. If that happens, then you will see that obviously in the equilibrium, either the quantity will decrease or decrease slightly, which is what we find. But important is that the fees will decrease. So the fact in the previous table, the fact that fees decreases is a strong indicator of that the demand is also going down. Now, but that raises the question, well, as passive ownership increases, why is the demand for shorting going down? While in the equities, people say the demand for shorting increases. And I'm telling you that in bonds, the demand for shorting decreases. So why does it decrease? Once again, now this is the logic that we have to follow. As passive ownership increases, other people have shown, and I'm going to show you too, that typically the bonds which are held by these passive owners being passive funds and or ETFs, bond valuation goes up. So these are more expensive bonds. If these are more expensive bonds, Josh is less likely to buy those bonds. Since Josh is less likely to buy these bonds, and my story is, well, hey, the shorting is happening in response to what Josh wants. Josh is the king, right? I, as the dealer, am just satisfying whatever Josh wants. Now, Josh wants to buy less. I, as the dealer, have less demand to borrow and satisfy Josh. Therefore, the shorting activity decreases. In the case of stocks, it's completely different. In the case of stocks, as the stock valuation increases, selling pressure increases, customer shorts increase and go on. Right? So I've already shown you the last. So there's like 3 parts of my logic, right? The first part is bond valuation goes up. The second part is the buying pressure goes down. The third is the dealers are shorting less. The third part I already showed you. That's the first part of the paper. Let me just close the loop and show you that the bond valuation goes up and buying pressure goes down, and then I will be done. As passive ownership increases, we find that the spreads go down, bonds are more expensive. These are more expensive bonds, Now, our story is Josh is less willing to buy or less eager to buy, let's say. Okay, I calculate the order imbalance for buys. I also net out the order imbalances to strip out the effects of passive ownership, etc. And we do indeed find that Josh is less willing to buy these bonds, right? So in some sense, the buying pressure going down, selling pressure going up is kind of the similar thing. It's just in the corporate bond market, Josh, instead of selling, or Bjorn, instead of selling, I can equivalently say Bjorn is less willing to sell these bonds. Or Josh is less willing to buy these bonds. But the key mechanism there again is that the activity is really intermediated by the dealers. The dealers sell less, and that closes the loop. The borrowing, the net buying is less. Josh wants to buy less. I have to do less in order to satisfy Josh's demand. That's why overall the demand decreases. Demand decreases. Supply obviously has increased. Demand has decreased. Equilibrium effect is obviously going to be that the fees decreases, which is what we find. And this is opposite to that of what happens in the equity market. Again, the main thing really is the constant across these two parts of the paper is that the shorting in the bond market is being done by dealers in response to the end user customer demand. Okay, so let's see. I am kind of on time, so I have like 30 seconds more, and I'm going to finish on these 30 seconds, and then I'm happy to take more questions. Okay, so basically, this is what I've shown you. Bond shorting is primarily for dealer market making, not end user speculation. Okay, bond borrowing costs appear to be cheap because the dealers have strong bargaining power. This is what Pankaj has been talking about, but we need to look also deeper into this. Well, if they have a bargaining power, they can just decide not to give the bond to to Josh. And that's something we have to look at. And finally, we look at passive ownership can ease short sale frictions and improving bond market liquidity. So let me go here, and this is my favorite picture in the paper. So I'm going to stop right here and take questions.
Thank you very much, Amit. This is super interesting.
Thank you.
And perfectly on time. Great. Let's see if there are any questions. Yeah, Josh,
Maybe
go ahead.
sorry, Said. No, Josh has a question.
Yeah,
Sorry, Josh, sorry.
I had one.
Sorry,
Well,
Josh, yes.
yeah, thanks a lot for an interesting talk. I was just wondering if maybe you could speculate a little bit on mechanism. Like what is it about the market structure of bonds that leads lending to be primarily driven by dealers versus, what is it about equities where
So maybe let me say something else. I don't know if that will answer the question or not, but let me say something else in terms of you're right. So these are back of the envelope numbers. So the question is, why is there fewer of beyonds in this market? The speculative investors, why is there less of shorting being done by informed investors like beyond? Right? That's kind of the flip side of the coin of what you're asking. And I think our response to that, we don't have lots of numbers, but our response is that shorting is quite expensive. The bid-ask spreads, everyone knows, in the corporate bond markets are higher, right? That clearly is the case. Then if you take the bid-ask spreads and you add the borrowing, so I have some number here, that amounts, the round trip for beyond would amount to about 58 basis points, okay, which is prohibitively expensive compared to what a typical bond return is. Right now, that obviously does not mean that Bjorn will never short, right? If his information is really, really good or strong, he will still short. But typically, the answer is that shorting in the corporate bond market is just too expensive for people like Bjorn to be that important in the market. As an anecdotal answer, right? It's just anecdotal, and it's not like we have done a big survey or something. But when we have spoken to 2 or 3 bond managers, and we said, hey, we have this paper on bond borrowing, can you provide us some like feedback? They said, we never short. So nothing. They know nothing. That so essentially, right? So I don't know if that kind of answers your question, Josh.
Yeah, I think that helps. Thank you.
I have a quick question, if you don't mind.
Yes, Marco, please.
Yeah, thank you. Thank you for the nice paper, Amit. Can you tell us a little bit how you think that creation redemption activity can affect some of the results on the
second part? So that's only about the second part of the paper.
Yeah, the second, because I think if I want a bond that an ETF has, I have 2 options. Either I short it, I borrow and I short it, or I can redeem some shares and get the bonds that the ETF is holding, right?
Yes.
And so if a bond is ETF eligible, then I
Yes.
have some kind of I have a substitute, right?
Yes.
If there's substitutes, then the demand goes down, potentially the price goes down. So that could be like a channel.
In explaining these results, right? This basically this
Yeah,
channel.
the
That's what
reason
you're-
why
that's-
exactly why there's
Yeah.
there's less shorting, because I don't have the bond, I could redeem shares
Correct.
of an ETF,
Correct.
and I get the
Correct.
bond, maybe a few extra bonds, but I get the bonds that I want, right?
Correct. Correct. So,
You know,
so Marco, I will think more, but just one small answer, not directly to your question, but maybe that might help, right? So when I have said passive ownership, and actually the results that I showed to you, the passive ownership here is defined as the ownership of ETFs plus passive bonds, but passive bond funds. Okay. If I do it separately, because I can obviously calculate passive ownership separately for ETFs and for passive bond funds, our results are in fact stronger for passive bond funds. So,
which makes sense, I
which
think.
makes sense.
Yeah.
Correct.
Yeah, because I mean, if it's driven by passive bond funds, the only way you can have those bonds is by borrowing those bonds. ETF, you can actually redeem the shares. Most of these dealers are authorized participants, right? So
Correct. Correct. But I think there is something deeper that we can dig into more, because we can look separately into just the ETF ownership and how does that affect uh, affect the mechanism that we have. I'll have to think more, and also, as you know better than me, we will have to again then look at the additional data on ETF creation and redemption baskets, etc. Maybe in order to dig deeper, which we can do, but right now we have not gone down that big exercise, right? As you know, it's a bigger exercise to do. But I understand. I'm going to write down, and we're going to think about it. Thank you, Marco.
So Amit, I have one more question.
Yes. Yes.
From your introduction, I understood that for the stock market, the stylized fact from the literature is that short selling is primarily done by informed investors. So then I was a bit surprised to see when you did your variance decomposition that it was roughly 50-50 customer and dealer.
Yes.
Were you surprised as well?
No, because I know. Good question. I have an explanation for that, and I tried to say it, but I was not very successful. The thing is, I mean, I'm using the same labels in the stock market loans also, customer and dealer, right? But you know better than me, right? These dealers, in the stock loans, I should really be calling them as liquidity providers.
Yeah.
Okay. And I should be calling these as liquidity takers. So let me not give the label customer and dealer in the stock market. Let me call them liquidity takers and liquidity providers. Now, the first thought you might have is, well, hey, somebody is shorting. That person is taking liquidity, which in my terminology would be the customer. Right? And that's your question. But it is possible that the liquidity providers are also informed short sellers. They just have information, not just for the next day or next hour, over the next few days. They're more patient. If they're more patient, many of what I'm calling as dealers, liquidity providers, could also be informed. In that sense, actually, there are other papers which talk about this decomposition of 50-50 aligns with the other papers, but those papers additionally show that dealers, liquidity providers are also informed investors. So in that sense, it does not surprise me, but I understand where the question is coming from. It seems like, hey, you would have expected this number to be, for example, 70%, this number to be 30%. You see 50-50, and that bothers, but it doesn't bother me.
Okay, very good. I get it.
Yeah.
Let's see if there are other questions. Yes, go ahead, Farshid.
Hi, Amit.
Farshid. Hi.
Great paper. I have a question. So I'm wondering if you have looked at what happens when a bond is added or removed from an index. In those cases, then you have a pure liquidity situation, and then maybe the dealer is when it is included in the index, the dealer needs to provide this to the funds. And then in
We
that
have
case,
not.
they might do a short selling. And then you can see how big this effect is compared to the overall short selling market.
We have not looked at that. So you would like me to do something like, for example, add a panel where something is added or removed from an index or something and see the dealer share. Is that what you're thinking, Farshid?
I'm curious to see. I mean, because this is a type of event that it is not information, right? So this is a liquidity event, and then we can see how strong the effect is around those times.
Right. So we can, fine, good. We have not looked at that. We have not thought of that, but we should, I made a note. We should look at that. Right now, the only reason for my hesitation is not that it's a good question. Only thing I'm thinking of is whether we would like to do it in this context, like in the context of this, or we may want to do it in the context of the passive ownership things. But anyway, that's for us to think.
Right.
That's for us to think. But I see the spirit of the question, and it's a good question. We have not looked at that yet. I keep going back to my favorite picture so that people remember this picture.
So while waiting for the last questions, let me announce that in 2 weeks we have Patrick Chang from Oxford for the next session at the Microstructure Exchange. So hopefully we'll see you again in 2 weeks. Let's do a final call for questions. So thanks a lot, Amit, for coming and presenting this interesting paper, and for everyone else as well. So have a great day, everyone.
Thank you, Bjorn. Thank you for having us. Thank you, everyone, for all the comments and the feedback. Thank you.